Okay. Is everybody on? Yeah, I think so. Everybody can hear
Everybody's
us?
here that's here, so.
Okay, thank you, James.
Yep.
Yep.
Thanks. Hello,
Andy.
everybody.
It's Armand. How are you, Andy?
What do you say, buddy? Thanks for all your messages. I really appreciate them.
Very good. Yeah. How are you doing on there? How's Austin?
You know, Austin's been a little disappointing with everything being closed, but you know, at least the weather's good. I mean, it's probably 85 out today. So
Very nice.
yeah,
Very nice.
I'm gonna head back to New York in a couple of days. So we'll see.
Very
Okay.
good.
Peter, are you on?
Andy's there. Andy
No,
Calate.
Yes, I'm
Yeah.
on. Hi.
Hi, Peter. Hi,
Andy,
Peter.
how are you doing?
Yeah, I'm good. I'm good. I'm glad we can do this.
Peter's there too. Peter's there also. Very good.
Yeah.
Peter.
Should we wait maybe a couple more minutes, or should we start now? What do you think, Peter?
Oh, I can't tell how many participants there are. Or how many are there?
There are 22.
Oh, 22. That's a lot. No, I think we should start.
Okay, thank you, Peter. Hello,
Okay.
everybody. Thank you for taking the time to your schedules to listen in. This is a special BQE session. I'm very happy to have my former colleague and good friend, Andrew Brenner from NatAlliance speak. Andrew is a very, very experienced, profound commentator on the capital markets. Actually, about an hour ago, he was on Liz Clayman, Fox Business, commenting on the most recent news, which was the Fed statement and Chairman Powell's subsequent press conference. So what we were going to try to do today is in a quick Q&A format, just, ask Andy to sort of opine on, this remarkable set of events that have happened, how the various capital market sectors have responded to it. Of course, we have this huge government intervention, unprecedented, and I'd like to get his opinions on that. Ultimately, we want to basically get some kind of like a thematic concept or thematic ideas kind of conveyed to you about where we are, where we're going, what signals he looks at in the markets, try to ultimately arrive at his, market intelligence and market expectations. So let me just start, since it's so timely. We had a Fed statement at 2 p.m. today Eastern time, and we had a press conference from Chairman Powell. Andy, you want to comment a little bit on that? While he's doing that, he just put up on the screen one of the most remarkable things that's happened in recent weeks is this amazing bond market rally we had. That's a graph in white of the 10-year Treasury yield going back.
Yeah, that's the 10-year Treasury over the last 2 years.
So we sort of see what happened starting in, we actually had a significant rally that first happened in summer of 18 when the general risk markets kind of like took it on the chin. You sort of see that happening. We had some stabilization in the middle of 2019. And then, of course, we see what's happened since the COVID crisis materialized in mid-February with a massive, massive, unprecedented rally from like in the high 1% area down to, right now we're on about 0.6% for the 10-year note. So Andy, with that introduction of kind of a unexpected and remarkable turn of events as far as the rates markets, you want to comment? You want to start with that?
Sure, Leon, if you look at this chart, which it tells you that back in November of 2018, hard to believe now, but the 10-year on November 8th was 324, and it got down to as low as 30 basis points intraday. The lowest close ever was 54 basis points, and as you said, we're barely above it right now. It's unprecedented in that the Treasury, because of the massive deficits being by Washington, the fact that the Treasury can still come to market with 10 years at 60 basis points and long bonds at $1.25, I mean, it's just crazy. I mean, I would think that rates should be, 2% 10 years and probably 3% long bonds, even with this. So the fact that they're still so low tells you a couple of things. What it tells you is that there's still a tremendous amount of interest in treasuries. Treasuries are still the cheapest of all the super sovereigns. I can't think of one off the top of my head that's cheaper. And the central banks will continue on to be involved. One thing Powell did say today is he doesn't really see the need to buy a lot of treasuries and a lot of mortgages going forward. He's putting his efforts into the corporate bond market, and he's done some remarkable stuff. The high-grade market, which was effectively closed about the end of February until the middle of March, just by the fact that the Fed announced that they were going to buy corporate bonds, something they have yet to do, but Powell said today they'll do it within the next few weeks. They've cut spreads in half. High-grade spreads have gone from, roughly high-grade, the CDX has gone from 150 and change down to around 90. It's cut that in half, and high yield has cut their losses or their widening of spreads by 50% as well. And what we've had is an unprecedented amount of new issue corporates. We've already had, since the market opened on March 16th with Oracle and Exxon, we've probably had 450 billion of corporates come to market. And there's just tremendous demand. And again, the Fed hasn't bought a bond yet, but just by the fact they're doing it. And they're not the only ones. I mean, the central bank of the ECB is buying corporates, as well as the Bank of Japan just announced they're going to double the amount of corporates. But you know what? Let's go on to what Powell said today, because I think that's the most important thing. Powell basically is staying the course. He's going to keep rates at zero until he sees until the economy's really turned around. We all know that in the next 6 weeks, you're going to have the worst economic numbers we ever seen, even the worst than Calitate's ever seen. I mean, this is going to be just horrible, but nonetheless, the Fed has got people looking ahead. They've done multiple programs. They're increasing the balance sheet in just tremendous amounts. The Fed balance sheet, which they started to increase, I use September 18th as a date where they stopped letting funds run off. It's been increasing at an annualized rate of over 100%. And even in the past couple of months, it's probably increased by 2.5 trillion. We thought that the balance sheet, which is about 6.5 trillion right now, would probably get up to 8 trillion. But we watched Richard Fisher yesterday on CNBC, and who's a former Fed governor and one of the smarter ones, basically said that he could see it going to 10 trillion. I mean, that's effectively more than half the US GDP. Just what the Fed's going to be having. And, it's not going to stop there. The ECB and the Bank of Japan are doing the same thing. We would anticipate that over the next few months and over the past few months, you're going to see an increase from the three major central banks of almost close to 9 or 10 trillion in what they're buying. So what has that done? It's stabilized corporates. It's allowed new issues to come to market. And even though the Treasury market, a lot of people say, well, the Treasury market's telling a different story than the equity market is. The equity market has obviously rallied dramatically from its lows of, I think it was probably March 10th or March 12th.
March 23rd, I think. Yeah.
March 23rd. Okay, so it's rallied tremendously since that date. I mean, I think April is going to be one of the biggest upticks in equities in many years. So that is a tremendous accomplishment. And even though we're going to see probably 25 million people unemployed. We're probably going to see unemployment rates of minus 20% or more. We're going to see GDP in the second quarter, falter at 20 or 25%. People are not panicking by this, or at least markets are not panicking by this. And I think the key thing to look at here, and what we look at, as Leon asked, what do I look at every day? I look at corporate issuance. I look at corporate spreads. And as long as high-grade corporates can come to market and issue paper and get money, I think that's a good thing. And I think that's gonna keep it's gonna keep the market from really going down. There are plenty of smart people out there who just said in the last, oh, Boeing just got cut. Well, that's not a surprise. There are a lot of people in the last week who are very smart and are very negative in the markets. Carl Icahn for one, Scott Minerd of Guggenheim for another, and Jeff Gundlach of DoubleLine for a third. They're very negative. But you know what? I'm not that negative, because what I look at is, yes, they've looked at markets and they've seen a second wave down many times, but no one has ever seen the Fed this involved. I mean, they're buying corporates, they're buying commercial paper. They're obviously bought treasuries, they bought mortgages. They're doing stuff in other mortgage-related products. They're doing some CMBS stuff. I don't have all the details in whatever, but they're definitely very much involved. And Powell said today, he's not done yet. He's going to do more. And there's plenty of dry powder that is being backed by the U.S. Treasury, where he can do a lot more than what he's doing. but he's had a lot of success so far. Now I've gone on. Go ahead, Leon. Ask another
Let me
question.
ask you two follow-ups. Before I do that, though, my apologies. I should have, in the interest of, you doing this right, I should have introduced you more formally, Andy. You're the head of international fixed income at NatAlliance, which is a Austin, Texas-based regional dealer, very active in some of the more esoteric sectors of the fixed income market. Let me ask you two follow-ups. The first one is, irrespective of the intervention, do you think the market's in somewhat better shape now because we have some of the risk assets held in stronger hands now than we had coming out of '08? And two, as far as the intervention, do you think they've struck the right balance between supporting the consumer side of the economy versus the corporate side of the economy? Or do you think they basically maybe are shifting or overweighted towards one or the other? So two questions to you, please.
All right. So as far as, their balance and what they're done, I think the Fed's done an incredible job. Are they helping the consumer? What they're doing is stabilizing the economy. Is it going to help the guy who works for AMC or Carnival Cruise Line or whatever from getting laid off? No, it's not, at least not in the short term. But it's going to allow the markets to come back. It's going to allow the economy to come back much stronger. Talk about strong hands, weak hands, so on and so forth. I'm not going to comment on 2008 because that was a totally different crisis. It really aren't a lot of comparisons outside of the fact you had huge moves in the marketplace. The 2008 strong hands, weak hands doesn't apply. But what does apply is there was just too much money, easy money, going through the last of 2019 into the first couple months of 2020, and you have smoked those guys out. We saw a lot of liquidations. We were buying things or seeing things trade at ridiculous levels. And that has calmed down. It's still a little weak in some of the municipal stuff. If you're looking to get a bid on New York MTA bonds, which are still A-rated, you're going to find that the one-year paper is still trading at 4 to 5% tax-free, which is, to me, not normal. It shouldn't be there. But, when you look at other things, corporate spreads are still much wider than they were in January. But I think they're reasonable now. I think there's, both upside and downside opportunity. I still think there's more upside because even though the Fed hasn't bought bonds yet, they will. And when they do, things are going to get even tighter than where they are right now. They won't go back to February 18th or the end of January as far as spreads go, but things are going to get a lot better from where we see. We think the market isn't done yet. It doesn't mean that the market is priced right, but the direction seems to be very positive.
I listened yesterday to a Fitch call about the CLO market, and two favorable things that they pointed out was, one, they pointed 8 industries that are most exposed to weakness due to the crisis. And look, of course, the entire universe of CLO bonds, which they rate, only about 20% of the portfolio assets were in those 8 riskier categories. And two, what they alluded to was the fact that the CLO market continues to be alive for new issuance. Of course, it's being supported by the fact that one of the funding programs the Fed has introduced gives them the ability to lend against static, newly originated CLO product, which obviously supports, valuations and trading activity. But in any event, let me go back to the question of corporates in general. I mean, you sort of said to you that potentially we're sort of at a right equilibrium level right now, given the breakdown between risk and rewards. Are you saying that without a COVID crisis, we were at ridiculously expensive levels in, let's say, beginning of this year? Is that your observation?
Say that last part again.
Given the fact you said we might be kind of at a fair level right now for corporates, given the risk-reward trade-off, are you suggesting that even before the crisis, we were at unreasonably expensive levels for a lot of the assets?
We were out of sight expensive levels. Things were just absurd as to how tight they were trading, and people weren't building in the appropriate spreads for the risks they were taking. High yield spreads were just ridiculous. And a lot of that stuff has gone back. I mean, I forget, high yield might have been down to 4.5%, 5%, and it gapped out to 1,100, 10% or 11%, and now it's coming back in. In fact, you can still see my screen, right? So let's let's take a look at, high yield. Let's see
You
how.
can do CDX, you can do CDX HY if you want, Andy. CDX HY.
Well, that is one way to do it, but what I was going to do is, and I hit the wrong one. All right. But nonetheless, high yield, right? The high yields, the CDX spreads, that I know off the top of my head. CDX high yield got as wide as 880, 890. It had been 288, and it's kind of settled into the mid 600s, the low 600s. So I think that gives you a pretty good representation of the kind of stuff that you've seen. It was way too expensive. Everything was way too expensive. One of the markets that is going to have trouble recovering is going to be the real estate market. With so many people not paying their rents, and I'm talking about corporate rents, I'm not talking about individual, mortgages, which is another thing that is probably going to have a problem. I would tend to think that the real estate market is going to have a lot of problems coming back, and I think you're going to see a lot of liquidations and a lot of changeover of who owns the bonds. And a lot of REITs just seem to be in a lot of trouble as well. A few of them have already gone out, but we don't think that's the end of it. So not all things are positive right now, but certainly the corporate bond market, the high grade bond market, is one of those that seems to be in decent shape. Secondary market for high grade is still not great. Certainly the secondary high yield market is awful, but things are coming back, and we'll see what the next 4 or 5 weeks bring. It's certainly going to bring lousy economic news, but I don't necessarily think that spreads are going to widen much from here.
Well, to throw a wrench in your somewhat favorable perspective, what about the fact that in the multiple years since the crisis, we had, due to low rates and expensive valuations, a massive increase in the outstanding amount of corporate debt? Doesn't that sort of set us up to be in like a bad position in the context of more risk intrinsically in the market? I mean, we've sort of had the improvement in the consumer balance sheet, right? But the theme was they improved, but the corporate balance sheets got more levered in the course of the years coming out of the last crisis. Are you concerned with that?
I'm really not, Leon, because a lot of the corporate issuance has been done at ridiculously low rates. So you know what? I mean, it's just like looking at the treasury market. When you look at the massive amount of debt that's been added, and yet our interest payments haven't really gone up that dramatically because the rates have gone down. Similarly, corporate debt, which is generally taxed, obviously it's a taxable expense. When the after-tax expense, many times you're talking one handles, two handles type stuff, at least for the high grade stuff. And as you go out the curve to the high yield stuff, there you might run into some more problems. But no, I'm not that concerned, but it is something that I do look at. But for right now, I think we're okay.
Okay. Now the next question, natural one, comes up, and people talk about this all the time. Longer term, what about the moral hazard issue? I mean, who should be the people who we should listen to, who are most objective and most kind of like practical about the moral hazard issue and what we're sort of setting ourselves up for later on? What do you think?
Let me give you an example of what happened today. Liz Clayman came to me before we went on the air, maybe around noontime, and said, "Hey, take a look at yesterday's Wall Street Journal article on Carnival Cruise Lines, and tell me." In the headline was, "The Fed bails out Carnival Cruise Lines," and she said, "Is that fair per se?" And my feeling was, after I read the article to see what the spin was, that it was fine. Because the Fed didn't lend money to Carnival Cruise Lines. You had the Elliots of the world that were about to lend money at 15 or 16% and take an equity interest. And then once the Fed announced that they were going to be supporting the corporate bond market, Carnival was able to issue debt. At first, it was the initial price talk was 13%. And they ended up pricing at 11.5%. And the bond has done okay. So, I mean, I think the fact, is there moral hazard? Yes, there is. But the reality is, as Powell weighs it, it's moral hazard from people getting fired and never having their job again, or taking a lot longer time to get their job back or a job back, versus is there some risk? Yes, there is. But as far as from the Fed's concerned, the Treasury has got the first loss, and then the Fed comes in after the fact. I'm not so sure how many losses the Fed's going to take. It's not going to be perfect. We've watched the ECB buy corporate debt for, I don't know, I think since probably 5 years. And there's been a couple of big hits, but generally speaking, they've made more money than they've lost by a good factor. So yeah, I think there's some risk. There is some moral hazard, but I think the bigger moral hazard is having the country go into depression. And right now, I think that's going to be avoided.
I think pretty much the spirit of what Powell said today in the press conference, actually. I mean, sort of in a roundabout way, I think he did comment effectively on the moral hazard issue. Okay. As far as valuation, let me ask you this question, Andy. Okay, so the Fed came in third week of March with all this amazingly large intervention of the Treasury. Are you surprised that despite that and despite sort of making risk assets, whether it's stocks or whatever, private investments or real estate or corporate bonds or whatever, despite making those markets much, much more stable and perceived more positively, why haven't we seen it back up in the fundamental levels of Treasury yields? Why aren't Treasury yields back behind 1% now? If in fact, the scare trade has been mitigated significantly.
Leon, the dealers don't make the kind of markets and treasuries that they've made in the past. The name that we know over the years, bond vigilantes, aren't around right now. I don't think they're far away from raising their head above sea level again, and I do think we're going to get there. But for now, Leon, you have central banks expanding balance sheets. The Fed has been decreasing the amount of Treasury debt they've been buying, but they've still bought a heck of a lot of Treasury debt over the last 6 weeks. You've got the ECB, buying a lot of their super sovereigns. And, and you look at it, and this is really a dumb comparison. We're the least dirty shirt in the laundry because our 10 years are still 60 basis points, and German 10 years, I didn't see. I guess I could look to see where they went out today. Probably went out around minus 45. Let's see. So German 10 years today went out at minus 50. So I mean, Leon, if you're a Japanese insurance company, if you're a Chinese insurance company, and whatever, you're going to look and see where you can buy stuff. Would you rather buy Italy, that's on the verge of going to junk at 175? Would you rather buy bunds, which are pristine at minus 50, or would you rather buy treasuries at 60? I think it's not a fair level. I think treasuries should be back 1 to 1.25% for 10 years, maybe on the way to 2. And like I said before, probably long bonds above 2 on the way to 3. But that's not going to happen right away. I do expect, as the Treasury is increasing their auctions, 2 or 3 billion every month, every auction, just for the vast amount of money they're going to need, I think we're going to start seeing higher rates. But for right now, there's still a lot of money in the system. Rates are at 0. You can get good amounts of repo. Balance sheet restrictions of banks are off. So there's still a positive carry. So I think it's going to be slow to see significantly higher rates. I wouldn't be surprised to see 10 years back up into the 75, 80 range next week. But we have, let's see, tomorrow's the last day of the month. We've got a very big duration extension in treasuries tomorrow, as well as we're going to have a reallocation because as well as treasuries did this month, the equity markets did better. So you're going to have a reallocation from equities into treasuries. So those two things should keep us steady, but only until Friday. And then, of course, you have treasury debt and you have a lot of issuance of corporates. So I do expect things to back up. But for now, we're the cheapest of the big names, and we get a lot of money coming into us.
Yeah, Andy, you mentioned repo. Maybe for the benefit of our students, could you speak a little bit about how much they broadened the type of collateral that the Fed is willing to lend against, and what the implications of that are, and give some historical perspective of what they used to lend against under normal times? Could you comment on that a little bit, please?
Sure. Historically, since Leon and I have been doing this for 25 years per se or more, we've rarely seen the Fed buy anything but treasuries, and then more recently mortgages. And that was pretty much established treasuries for a long time. In mortgages, the Fed was a bigger buyer as quantitative easing took place in the earlier part of this decade. But since then, actually right now, that's all the Treasury owns plus they own a little commercial paper now, or they've lent against commercial paper. But now they're lending against commercial paper. They're going to buy corporates. They're going to buy portions of CLOs. They're going to buy portions of CMBS. I don't have all the details because those aren't products that I trade. But there's no question, and the Fed is going to make sure there's plenty of money. This has not been an evaluation thing. This has been a liquidity squeeze. And one of the things, if you go back, and a lot of people are going to disagree with me on this, but the 2008 debacle was not the traders of the banks. They weren't in the wrong at all. It was the banks themselves. It was SIVs. It was some big hits. It sent Bear Stearns out of business. It was over leveraged, sent Lehman Brothers out of business. But they put in a Volcker Rule, which basically eliminated back books, and I'll probably have to explain what back books are.
Yeah, could you please do that, Andy?
What's that?
Could you please explain back books, by the way? Thank you.
I will. Let me just finish the thought. And they cut dealers' positions down to the point where collectively, I don't have the numbers off the top of my head, but maybe dealers had about 500 billion they would put in capital towards their corporate desks. And now that number, I'm sure, is basically risk capital. And this is where you come in, Leon, because you know risk capital better than I. That number's probably down inside of 50 billion now. So dealers don't have the ability to take on balance sheet. As far as back books, it's basically how it sounds. When I used to run a desk at Nomura and then at Guggenheim per se, or actually Nomura, we would have a bunch of guys that would sit behind us. And if anything the line traders didn't want to bid on or what have you, they would get the opportunity to bid on it. Plus, they would put on very large arbitrage trades. They'd put on a 5s, 10s yield curve, whatever. They would always have bids for something. And they might have balance sheets in the area of 15 to 20 billion. And that was a norm. And I'm sure it was bigger at the Merrill Lynch's of the world and the Goldman Sachs. I mean, Goldman Sachs used to be one big trading shop. And then they started to cut back as to what you can have, and then the Volcker Rule and so on and so forth, to the point where dealers are just basically a very small part of liquidity. So when things started to get bad, the Fed realized, even though I was pounding on the table over the last 3 or 4 months, but the liquidity was bad, and the Fed needed to put liquidity in the market. And then one day they woke up and they seemed to agree with me, and that's what they've been doing ever since. And the markets are trading better for it. I think I explained it, but if I missed a piece, let me ask.
It's funny, Andy, because on one level you would say that with much less capacity as far as balance sheet size on the sell side, that you would think it'll be a negative, particularly in times like this. But what you're sort of suggesting is maybe it means that there's less product that's sitting that has risk in it on dealer shelves, which probably is supportive overall for valuation and general activity because they're not basically confined to sort of managing their internal risk as much, potentially, right? Is that what you're sort of suggesting?
Yeah, no, I think that's true. And I think you're also finding, the biggest primary dealer in the world right now is the U.S. Federal Reserve. There's no question about it. I see your brother just hopped on his picture in front of me. So, when you guys were at Salomon Brothers, that was one of the biggest bond shops going around along with Goldman. And, there is no Salomon Brothers anymore. Citi is pretty respectable, but the number of dealers and the amount of money, the amount of liquidity in markets that are significantly larger than when we were in our primes, you'll find that the Fed is by far and away the largest primary dealer, and it shouldn't really have had to be this way, but they kind of backed themselves by poor regulation. But nonetheless, what the Fed's doing right now, I'm 100% in favor of, and the fact they're all in and they're not giving up and they're just going after more and more liquidity and trying to improve things. Once the economy starts to open up, which I'm not a medical doctor by any means, but as soon as it does, I think things are going to get better very quickly.
Okay, let me, right now, we have one question via the chat I'll ask you, and then also open up the floor to other questions from the audience, please. First question, Annie, is the following. This is from Pravesh, one of our former students. This somewhat coordinated fiscal monetary stimulus we see, do you think that this will dampen the impact of the unemployment rate in the consumer credit market? Do you think that benefits reflected on, or do you think that the benefits as far as consumers will be little to none?
No, I think consumers are going to benefit. I mean, it obviously the fact that the Fed has opened up the corporate market and Exxon borrows, certainly the relationship as to how does that help the guy on the street may not be obvious on the front part, but what it's going to do, it's going to allow corporations to stay in business as well as to come back quickly. So I think that even though that there are a lot of employees, certainly airline employees, certainly restaurant employees, you know, you're going to have a real slow bounce back in these industries. And you know, I mean, I'm reading articles where airlines are running at 5% of capacity, and that might even be generous right now. So, but I do think that things are going to come back and come back quickly. And I think the fact that United Airlines was able to sell stock or borrow more, issue bonds, I think is going to be helpful in keeping United Airlines in business, and it will hire back their people. So ultimately, I think it's very positive. Look, what the Fed is doing helps corporations much more than it does individuals. What the government is doing with the CARES Act helps individuals more than it helps corporations. You might want to challenge that last statement, but that's the way I see it.
Okay. Any more questions, by the way? Actually, there's one more question from my former colleague, Bill. Going forward, do you think that the impact of the Volcker Rule on dealer capacity will force the Fed to effectively be a backup source of liquidity for the market in future, quote, dislocations, assuming the Volcker Rule does not change the remaining? But you may want, Manny, could you maybe explain again to our students what the Volcker Rule is and what its implications have been?
Well, I'm going to generalize. The Volcker Rule is basically capped what dealers could do. It used to be the fact that a dealer could go out in the marketplace, an individual at a dealer can buy bonds for his book because he thinks the 10-year is going to go up in price, or he thinks that General Motors bonds are going to do better, or whatever the case may be. The Volcker Rule kind of put the primary dealers on notice that they don't want you to speculate in the marketplace. And I think speculation is what has made this market. Again, what they looked at is the 2008-2009 debacle and said, we have to cap traders. It's just using the analogy, you run out of gas and you decide not to get more gas, but to change your tires. I mean, one has nothing to do with the other. So the reality is, yes, this has forced the Fed to be a dealer, which I think the Fed's going to, and Powell did say this today. Look, Powell said, today is not the day of which we try to analyze and second guess ourselves, but we will do a lot of deep searching as to how to determine how to go forward. And I think one of the things they have to do is get rid of the Volcker Rule. I would also love to see him get rid of Trace, but that would probably open up a can of worms, because the more money that dealers can make, the more liquidity they're going to provide. You cap them from being able to make money, and you cap yourself from a lot of liquidity. So you're going to have trade-offs. Ultimately, you don't want the Fed to have to do this again, or at least certainly not in the next 20 years. But you've got to solve this. And I think the Fed was partially responsible for the lack of liquidity, and I'm just glad that they stepped up. In other words, we'd be at 2,000 S&P or even lower.
Reminds me of an observation a friend of mine made to me a couple of years ago, who he was running this rates desk at one of the primary dealers. And he said to me that, well, look, I'm analyzing, my allocation of risk capital and balance sheet. I think I can make more money, more safely by engaging trading repo than holding cash treasury to the market maker. He said, the Fed doesn't want me to say that to them because they've assigned me this responsibility of making markets. But from my commercial rationale, I'm better off using my balance sheet to fund treasuries than to hold them in inventory and make markets. And he said there's kind of a disconnect here, because what my responsibility is as a primary dealer and what I'm advising my management as to what the best use is of my risk capacity and my balance sheet. So kind of something in the spirit of what you're talking about unintended consequences. So
So
to
Leon,
speak.
let me give you an example on that. So, one of the things is as the Treasury market became, there was the first to unhinge, or maybe the corporate market was the first, but the Treasury market was quickly thereafter. We were watching markets at night during Asian time, and the bid offered side on old long bonds, which is not not that illiquid of a bond. And, usually maybe a quarter point, maybe 3/8 of a point bid offer. It was 5 or 6 points bid offer a lot of times. And it was only in the last 3 or 4 weeks where the Fed has come in and stabilized these markets to the point where the old long bond is now an eighth or a quarter, bid to offer. And it was just no liquidity. And that is partially because of what you're saying. Guys looked at it and said, I don't need to be, I'll make X amount of money by doing repo or doing riskless things or lending money to the Fed. Or what do I need to go out and make markets for? So you know what? So a lot of truth in that.
Okay, a couple more questions, Andy, from the chat, from Peter, our chairperson. Convexity effect on bond yield says that when interest rates become more volatile, yields fall. To what extent are the low yields we are seeing a reflection of the higher anticipated volatility of interest rates?
Well, always a tough question from the chair of the department.
Okay.
Certainly the lower interest rates cause more volatility, even though we haven't seen a lot of volatility in the last few weeks. We've been fairly range bound. 10 years. I mean, I think today 10 years was probably in a 4 or 5 basis point range. A few days it was 3 basis points. But going back a few weeks ago, it was 20, 25, 30 basis points, 10-year range between overnight and now. As far as convexity goes, there are a lot of things happening in the mortgage market that I just don't have a good handle on. There are a lot of people that are afraid of not getting paid. A lot of people are not paying their mortgages, so on and so forth. I'm not the best person to answer that question, so I think I'll just leave it there.
Peter, would you like to elaborate on that, please? Peter?
Hi. Yeah. So, well, I mean, I was really thinking about long dated treasuries and just the fact that when future short rates are volatile, this raises the price of the treasury, so lowers the yield. And, I was thinking maybe it's quite reasonable given what we're seeing that expectations or anticipations of volatility of future interest rates have heightened. Anyway, I liked your answer. Thank you very much, Andy, for it.
Yeah, there is an index, Peter and Andy. There's the the Merrill Lynch Move Index, MOVE.
Sure.
Yeah. I don't know how it's performed. I assume it was very, very high at some point last couple of months. I don't know where it is now. Can you look it up, Andy, the Move?
Yeah. Let's see.
There it is. Okay, wonderful.
All right, so this is a 1 year of the Move Index, and I'm just trying to see, okay, so, really? Yeah, I'd say it's pretty volatile, Leon.
Peter, that's Gaussian, right? Of course, right?
I'm actually not familiar with how it's constructed, but what we're interested, I mean, the index itself is volatile, but what we're actually interested in is the level, right, of the Move Index in March, let's say. So, which is very high, right, compared to where
very
high, yeah.
Yeah.
Right.
So, my guess is the way this is constructed is similar to, say, VIX. So, the level is an indication of how, what the market is thinking is the volatility of future whatever share interest rates, whatever it is. So, just because bond prices, can't go negative, interest rates can, but bond prices cannot. The fact, so when rates go up, and I realize they're going the other way now, but when they do go up, bond prices fall, but they can't go negative. So there's this convexity effect, right? So anyway, you can make money off it if the level of the yield is not taking it into account. But I'm thinking the level of the yield, which is low, is taking it into account. So I was just wondering if it looks like things are in line. So it's a potential explanation for the low yields, besides, the ones that have already mentioned, which are certainly there.
Certainly, though, a lot of supply is coming. No question about that.
Okay.
Right. Yeah, we sort of see that. It looks like it actually hasn't come off. It looks like. Kind of looks like the level is pretty much where it was in mid-March. I mean, actually, it's higher than mid-March. Is it the red line? Is that right? That's the moving average. Oh, no, I'm sorry. No, it's the white. I'm sorry.
I thought it was the white. Yeah.
You're right,
I think-
Peter. It's the white. So
yeah.
it's come down a
It's the
tremendous
white.
amount. Okay.
Yeah,
Yes.
it's come down. That's true.
Yeah,
it's
it's
come
got
down.
on March 9th, it got as high as 163. Today it's 57.
Oh,
So
right.
it
Yes.
looks like the 200-day moving average is 74. So it's come down quite dramatically.
Agreed.
Okay.
And
Question now. I'm
But
sorry.
so
Peter.
let's say if it was what I was saying, then as the volatility came down, it's really the anticipations of volatility came down from March to the present, let's say, then what should happen to yields is they'll go up. Is that fair? Is that what we've seen?
They're a little bit soft. They're like, 0.6 as opposed to what 0.3 was a low print, right, Andy? 0.35 in the 10-year? I don't know, something like that, right?
0.31 was the low print,
Yeah,
but it was
yeah.
only there an instant. And
Yeah.
it was a gap thing. It was like trading at 36 basis points, then it traded 31, and then went to 36, and it closed that day at 54. And we haven't seen a close below that. We haven't even seen that close again. I think
I'm
we
just
got
saying.
close to
Yeah,
it.
I'm just saying that if I
There's
told you in mid-March that over the next 3-4 weeks there'd be a massive intervention supporting the corporate bond market, a $2 trillion CARES plan, I would not have thought that from March 23rd to today, the bond yield would only be higher by 30 basis points. I just would have thought they would have sort of sold off more. But you made the observation, Annie, about the global demand for pure risk product, and we're the least dirty shirt in the house is how you phrased it, right?
I did. One other thing I'm looking at my notes that I find very interesting is that money supply, which is something that we used to look at when we were much younger, and we kind of ignored it for the last 10 years. Money supply is worth watching again. It'll come out again tomorrow. It's a 1-week lag. But over the last 4 weeks, you've had money M2, going up at about a 75% annualized clip. And that has a lot to do with the Fed just, buying stuff and issuing credits and what have you. But the velocity of money, which I'm not about to explain because I don't understand it well enough, has been going down. So I find M2 is worth watching, but velocity has not made it as valuable as I would have liked.
Yeah. Peter, I'm sorry, I cut you off. You had another comment? My apologies, Peter. You had something to
No, I
say?
didn't. I'm fine.
Yeah,
I'm sorry.
I'm make a comment about the about Peter's statement about the volatility. Also, what Andy said, I think that what happens is when you look at the volatility rising so much, you got to look at the effect on, let's say, the mortgage market, where the options become more valuable, and therefore this hedging goes on in that market, and that causes treasuries to move, either higher or lower depending upon the hedging that goes on in the mortgage market. So there's a pass-through effect on volatility that goes back into the price of the treasuries from hedging, which is a big part of it. So I think when the market reacts with a high yield, with a high volatility in treasuries, there's a feedback loop mechanism that goes into the hedgers, the mortgage hedgers, which then have to shorten up their duration because the mortgage becomes shorter, so they got to buy back their shorts. So there's a lot of flow through that goes on, which probably affects the price a lot. Right, right, Andy?
I think you're onto something there, Armand.
Yeah, and also what happens there is the secondary effect is the following, right? The bond market rallies and mortgage valuations cheapen, right? As they get cheaper, that's a little bit incrementally less of an effect on the refinancing attractiveness, because basically the primary rates are not going down as much. So in fact, if the bond market rally brings cheaper valuations of mortgages, you have like a little bit of a weaker effect on prepayments because you're printing relatively higher mortgage borrowing rates opposed to treasuries. And that sort of attenuates the need for more duration because the mortgages are not shortening as much as you think. So also the impact of the change in rates on the valuation mortgage has an effect as well. Okay, we have another question from Professor Abinoleda, our colleague at Quant, Andy. How real is the Fed put for equities over the next 6 months, and also the impact of the upcoming election in your view? How real is the Fed put for the rest of the year?
I think the Fed, even though it took tremendous abuse from the president over the last year and a half, and has only gotten compliments in the last 4 or 5 weeks, I think the Fed, I think Powell, let's back up a second. I think Powell's different than any of the other Fed governors we've had in a long time, in that Powell's not a banker, and he's really more of an investment banker, and he's looking at this economy very differently than Yellen or Bernanke or Volcker or Greenspan or what have you. And while they might have done similar things, and of course Yellen and Bernanke made some comments early on as this was looking to start that maybe the Fed needs to get a little bit more involved. I think Powell is such that he's going to continue on as long as he sees problems in the economy, as long as he sees very high unemployment. Look, if he doesn't see inflation, what's the reason to raise rates? And of course, he's not a negative rates guy, which I think is great, because I think negative rates have just absolutely annihilated Europe, and I don't see where they've done a lot of benefit to Japan. So I think the Fed put is going to be there for a while. One thing that worries me is that there might be a push towards, has the Fed done too much? Have they taken too much risk? Should we lose faith in the Fed? And there might be a downtrade from that. I would not put that past us, but I do believe that the Fed put is there, and I think it's going to stay for the rest of the year, well through the election. As far as the election and rates, one would have thought that Trump, being a real estate related guy, would have done an infrastructure program and would have done it much earlier. And the fact that interest rates have been low for a long time, I would have thought that he would force Mnuchin to issue 40-year, 50-year paper, because the market will take it. And I've listened to the arguments that Morgan Stanley and JP have put up, and that they said they don't want to trade in this long paper because the government, there may not always be demand for it, and we should only issue stuff of which we have a regular calendar. I think that's bull. I mean, I would love to see the Treasury do a $2 billion infrastructure program funded by long 40-year, 50-year, not necessarily treasuries, but maybe something like the Resolution Trust Corp that funded savings and loans, have that government guaranteed and have that, a little bit different product. And I think the market would take $2 trillion 40 years. That's just my view.
Well, Austria did a 100-year bond, right? During the period of QE, I guess, European QE, right? Andy, they do a 100-year bond, I think, Austria, so sovereign. So, okay, let me open this up, please. We have about 15 minutes left. Let's open up to questions, please. We'd love to hear your thoughts on Andy's observations, challenging some of his points of view. Anybody like to chime in with a question, please?
I have a comment about what's happening with the market in terms of the risks now in treasuries and corporates. If you look at the price risk now, in terms of duration, dollar value of 1, that if you hold a treasury bond right now when rates go up 100 basis points, you're down about a quarter in your principal, immediately, and across the board. So look at the losses that will be entailed now if you have even a small rise in rates on a basis point, basis. 100 basis points will give you almost a $25 loss in price. So I think the Fed's stuck now. The Fed can't let rates rise at all, ever. I'm telling you, because if you had a rate rise of anywhere near what you had in the old days when you had rates go up 400, 500 basis points, you'll have an enormous principal loss across the board, pension funds, insurance companies, and globally. So I don't know how the Fed's going to operate in this environment. They've sort of stuck now with this low rates scenario for a real long time.
Well, let's talk about a couple of things. first of all, one of the benefits is that as the government increases their deficit, the amount of money spending for interest expenses is not going up anywhere near what it could be if we were at much higher rates. No question about that. So that's a benefit. But you know what? At some point, you're going to have higher rates. You're just going to have to deal with it. In other words, you're basically going to have the Fed. What you're talking about is monetizing the deficit, and you're going to have that in perpetuity. And I don't see where that's healthy at all.
I mean, it's tough to say how but I don't know how these companies could, given the whole pension problem and everything, how could these companies, the economy, absorb this kind of a price loss? They're stuck at these levels. Like if rates go to 8%, just to think of the loss.
Well, I'm not going to 8% just yet. I'd be real happy with, 1% 10 years, maybe getting to 1.25. I see the chart point around 130. Maybe I see long bonds getting, back to 2% or 230 or something like that. I'd be very happy with that because I think it would show that there is some risk in owning treasuries. Right now, there doesn't seem to be any risk. I mean, it seems like we're at the same rates, give or take, every day. And I think that's about to change. And we'll have to wait to see what happens.
Well, that's been the problem with, I think, with this, what's happened with some of these hedging areas where at the whole risk parity, hedging where you would hold treasuries as a hedge against stocks, and then that sort of broke down at some point in this cycle.
Dalio lost 20% in the last month or something like that. I don't know how he did this month, but
that was all those, even Cliff's fund lost when they were saying they said that the treasuries didn't balance out the equity loss.
Well, it seems like we've had sort of we've had like almost a generation of people trying to explain why bond yields aren't higher. We had Bernanke in the, I guess, 2000. Well, no, I guess it was Greenspan, I guess, when we talked about the conundrum, right? They were started talking about 2004. Looks like every cycle we have a new reason for why bond yields aren't higher, right? I mean, maybe it's because, as Armand alluded to, maybe you have risk parity. You have people who buy into that concept of trading off debt versus, risk assets, whether it's equities or equity vol or corporates or high yield or whatever. And I think that's a persistent kind of theme. More people have bought into that offsetting effects. Marco just asked a question again, Andy. Is it purely a flight to quality issue that's still out there as a backstop, and that's why yields aren't higher? How would you comment on that?
I'd say there's some of that. I mean, there's no question that central banks are still big buyers of stuff. I think there's a little bit of a flight to quality, but as Armand said, what's the benefit of buying 10 years at 62 basis points? I mean, your upside downside risk is what are you looking for? I mean, eventually money supply, we learned, is going to lead to inflation, but it's hard to believe when you had oil prices at the beginning of this week trading at negative levels. And, you can gas up around $1 for a gallon in many places in many states. So, I mean, we wonder when inflation is going to come back. But yeah, there's certainly a flight to quality aspect. But you know what? Ask yourself this. You really want to be in an expensive flight to quality thing if the Fed is there, stopping you, giving you backstop for everything you want to buy? I mean, as long as the Fed's there, I just don't see where interest rates this low makes sense. I'd rather get some corporates at 4% or 5%. Or whatever the case may be, and they're out there. You can get good deals at 4 and 5%, and you can buy other things at 8 or 9%. They're out there, and I'd rather barbell the risk.
Yeah, I think that seems to be a pretty pervasive sentiment, I think, across the board. Again, I think, you started off by sort of saying that you're looking at the wrong market. If you're looking at the Treasury market to basically challenge the effectiveness of what the Fed and the Treasury are doing, you're kind of like misplacing your attention, right? There are other reasons why yields are stuck where they are right now. It doesn't mean that there's quite a bit of cynicism, or some bit of uncertainty about the effectiveness of these actions, I think. We have about 10 minutes left, 5 minutes left. Any more questions, please? Please Oh, one more question from Bill. Can you see the question, by the way, in the chat, or should I read it, by the way?
I don't see the
I'll read
chat,
it.
so go ahead.
Is there any justification to the notion that the Fed purchases of treasuries represents their attempt to monetize the federal debt, a sort of modern monetary theory from progressive politicians and economists with training wheels?
Well, that's what's going on, of course.
Yeah,
It is that
yeah.
the Fed is embracing some sense MMT, which is still not, until now it's been sort of discredited, but now it's become, as an accepted dogma, some sense. I don't know if that's going to maintain itself, but that's clearly the case. That what they're doing right now is MMT.
Let me open it up to the entire audience, please. Yeah, sorry, and let me open it. That's a wonderful question, Bill. Let me open it to the entire audience. Anybody want to comment on that? Is this basically a hidden way to implement MMT? Anybody in the audience? Any economists in the audience?
Well, that's what it's. There's been a couple of articles about that in the FT about that they're really making a statement that we can monetize the debt, which was there's no way the Fed could be able to operate what it is now without doing that. So they're and then limit seems to be no limit. It could be 10 trillion, it could be 15 trillion.
Well, yeah, you know what? I mean, certainly the funny thing is that the Fed still says that they don't subscribe to the idea of MMT. But as you pointed out, their actions clearly do. So on one side, they're saying we don't believe it, and the other side, they're doing it. And what you're seeing is the liberal side of the politicians, the Sanders and the Cassios, whatever, have also been talking about MMT. The idea that they could basically fund the whole government deficit and continue to increase the government deficit for, liberal related type causes without any effect. At some point that will come home to roost, and we're going to have to pay for it. But for right now, it's still there. And I think once the economy gets better, we're going to really have to deal with this government deficit of unlimited proportions. 100% of GDP, whatever the case, or 100, whatever, 100% of GDP, and so on and so forth. It's going to hurt us. But for right now, it's working. And as
what
Powell
they're
said
saying,
today,
I think they say the Fed does actions now, and they're waiting for the economy to catch up. You see, that's the whole thing. They're waiting for the economy to catch up, maybe a couple of years. That's the whole thing.
Yeah, but at the end of the day, it's not the Fed's role; it's the government's role. And in the government, you had great economies over the last 3 years, and you basically had one deficit increasing after the other. So, what scenario is going to actually allow you to decrease the deficit?
Right. I know. Yeah.
Today, the journal points out that we're talking about a deficit that's 18% of the GDP. And that's sobering when you realize that the ECB limit is 3%, right? And we're printing 18. So any more questions from the audience? Please pass on your thoughts on this. It's very, very open-ended kind of a session. So we'd love to hear from the audience. Anybody? Andy, any final comments from you?
No, Leon, I wish everyone to stay safe. I look forward to getting back into New York. Hopefully I'll stay there more than 20 minutes before I head up to Maine. But, stay safe, stay well. And we're in the midst of volatile markets, and feel free to reach out to me if you have any questions. Always available, always on Bloomberg.
Okay, Andy, thank you very much for your wonderful comments and your insights. Thank you, everybody, for listening and spending time with us. And stay safe, everybody.
Thanks,
Take
Andy. Take care.
Bye.
Bye, Peter.
Bye.
Bye.
Bye, bye, guys.
Bye.
It was a good talk Andy gave. Yeah, I mean, it's good. It's good, like practical talk. He talks about basics. I think Mike Yampol was on. Andy Calty, who also was there. Was it Ed Weinberger? No, he wasn't. I didn't see him.
didn't see Dean Yang or Dermot when they weren't there.
Yo, Armand.
Hey, Mike, Mike has sent me a text. I'm on the phone with Leon. Mike over there. And Mike there?
Yeah, your Zoom is still open, and there's a bunch of people still here.
Oh, okay. Hang on, let me
I'm going to hang it up now.
hang up. Okay. I'll call you back.
Actually, I'm going to be in some meetings this evening, so it's not a good time to chat.
All right. How's the thing going? Job search going? Good? Coming along?